welcome to Indianomics. This monetary policy, while stock markets are hoping for a 50 basis rate cut, bond markets are not worried about rates. They are just hoping for easier liquidity. So what is liquidity management? All central banks, like the Reserve Bank, have to create money to fund GDP growth. The growth in money supply, or M3, has to be roughly equal to the nominal GDP growth. Now, every rupee printed by the Reserve Bank travels from deposit to deposit as people transact. This is the money multiplier. How much new currency, or M0, a central bank must generate will depend on the money multiplier. In times of high economic growth, M0 can multiply itself even 6 times. In times of slow growth, it may multiply below 4. Separately, the Indian banking system also loses money. Firstly, because of currency leakage to the public. In mature economies, all payments are done by cards or on the internet from bank to bank. In India, we still withdraw cash to make small salary payments and other payments. During festival times, more money leaks out of banks. Likewise, during elections, say experts. A second way by which money leaves the banking system is when the Reserve Bank intervenes to sell dollars. It sucks out rupees. Finally, money temporarily leaves the banks when companies pay advance taxes. This money sits in the government's coffers till the government spends it. The reason why liquidity has become a talking point is that since January, the liquidity deficit with banks is as high as 1.5 to 1.8 lakh crore versus the Reserve Bank's stated policy that the deficit should be around 80,000 crores. Post-advance tax a payment on March 15th, this deficit has gone up to 2.5 lakh crore. RBI says it is anyways providing the deficit liquidity through fixed rate repos and numerous variable repos. But bank treasurers say if the system is deficit and so hugely deficit, banks are always chasing deposits to get cash, and hence Reserve Bank's rate cuts are not passed on. So what should RBI do to restore liquidity? It can't keep buying dollars unless there is a flood of inflows. If it buys too much of government securities, that is, if it creates M0, and then if credit picks up, there is a dollar inflow, there can be too much cash, leading to inflation. In fact, that's what happened between 2010 and 2012, and the excess liquidity was responsible at least partly for India's double-digit inflation. So the questions to ask are, 1, how should the RBI bridge the current cash deficit? How much should the deficit be? And finally, when its stance is accommodative, that is when the RBI is cutting rates, should it keep the banking system in deficit at all? To answer all these questions, I am joined by Hitendra Dave, Head of Global Banking and Markets for India at HSBC, and Neeraj Gambhir, Managing Director, Head Fixed Income Nomura India. Hitendra, let me start with you. Do you think the Reserve Bank has got its liquidity management all wrong?
Yeah, hi Latha. I think two parts, if I can just start off the discussion. I think one is a generic thought around what is an appropriate liquidity condition, whether it's a surplus, whether it's a deficit, in the context of a given monetary policy situation, whether you are tightening, whether you are sort of being accommodative, etc. So I think that's one part of the debate, and I'm very pleased to note that I think the Reserve Bank, after the last policy, actually mentioned that they are undertaking a review of what is an appropriate level of liquidity, because that's been a matter of significant debate in the marketplace about whether we should be 125 basis points lower on the policy rate side, but in terms of liquidity, we are more or less unchanged, and as this discussion will show, possibly we are a bit tighter. I think the other part around the numbers that you mentioned, from March of last year to March of this year, the loss of permanent liquidity on account of increase in the currency in circulation is roughly of the proportion of 200,000 crores. And there's another about 40,000 crores higher, which the banks are maintaining by way of higher balances with the Reserve Bank of India. So that's permanent liquidity loss of about 225 to 250,000 crores. Now against this, it's a simple set of how much has been added by way of permanent injections. Now we do know that RBI has only 3 tools of permanent injection. One is CRR, which they currently don't really have a preference to experiment with. Second is increase in their FX assets, and third is increase in their rupee assets. And at least the numbers that we can figure out would suggest that they have added about 56,000 crores by way of increase in rupee assets, which is the OMOs, and a similar number by way of increase in the FX assets, which is about between $9 to $10 billion of purchases. So that leaves the gap, and this gap of somewhere around 100, between 70 to 100,000 crores is showing up in the fact that for the same GOI balance, the LAF number has gone that much higher.
Okay. Well, Neeraj, would you broadly agree with these numbers that the Reserve Bank's addition of liquidity has been less than the loss of liquidity because of FX and other reasons?
Yeah, I think the key word here is permanent liquidity. See, this is a, I would say it's a tautological statement that if banking system is running short of the what is called a central bank money or primary liquidity, then RBI has to provide that liquidity, otherwise the banking system will be defaulting on its CRR requirements, which Reserve Bank actually does by way of, by way of its term repo operations. And because these operations are temporary, the system has to go back again and again to Reserve Bank for borrowing this money, which creates this sense of, lack of liquidity in the system. So I think the key word here is how much permanent liquidity that you are creating in the system, or if not permanent, at least more enduring liquidity you are creating in the system, and how fast are you creating that liquidity. I mean, if let's say, these calculations can be done at the beginning of the year with a reasonable degree of accuracy. What is the amount of permanent liquidity creation that the system will require? Now, the question is whether you do it linearly through the year, or you wait until a very late time in the year and then you create that liquidity. I think that's the key issue here in my mind.
Neeraj, normally FX flows are healthy in Jan-March, but this year, probably because of the Chinese yuan devaluation and the scare about emerging markets, there was an outflow of capital. The RBI could not have done the OMOs earlier, and if it did do the OMOs now, it runs the risk of further rise in M3 and therefore endangering its inflation position. Is that a fair argument?
I would say that any liquidity management of this nature requires, and given the setup that we have, institutional setup that we have in India, requires a considerable amount of judgment on behalf of Reserve Bank to see when that permanent liquidity injection is required, what is the most appropriate time for it, and if there is, any any changes in the real world as against the judgment, then obviously it leads to either tightness of the liquidity or excess liquidity. What I would say is that if you are in a accommodative monetary policy stance, then the preference should be to give system more liquidity rather than less liquidity, so that even if you err a little bit in your calculations, if the system is surplus, then the ability of the system to sort of carry forward the accommodative monetary policy stance into the real rates of economy is that much more higher. I think that's the difference here. I think the point is that Reserve Bank has been waiting a little longer in terms of providing that liquidity than probably the accommodative monetary policy stance would have warranted. Okay.
Well, Hitendra, I assume that this is your argument as well, that the Reserve Bank, it is not a question of how deficit it is. The point is the Reserve Bank should never be in a deficit mode, that actually we should be operating at the reverse repo window at a time when the RBI is in accommodative stance. Is that your point?
No, see, as I said, I think, there are schools of thought whether, you can have surplus liquidity without the operating rate becoming the reverse repo rate. And now the RBI has various tools. Earlier on, 3-4 years back, the RBI did not have tools. So either it was reverse repo rate or MSF rate. Now they do have this thing called the variable rate repos and variable rate reverse repos. So as I mentioned earlier, I think once you are relatively clear that the stage of the monetary cycle merits a much more easier liquidity condition, as in defined as not a deficit of 0.5 to 1%, but a surplus of, let's say, 0.5%. But you don't want that 0.5% to go to reverse repo rate for whatever reason. Those are, that's a point of a separate discussion. You can easily drain it at 2 basis points below whatever the operating repo rate be. But to come back to the point you were making earlier, I think at least looking at the data that I have gone through, it does appear that your point that I think there was a certain degree of assumption that there would be an increase in the FX assets, because that is how it had been working for most of 2014 and first half of 2015. And I think that switched off from the original Chinese devaluation date of August, and that's what is causing this sudden need, certain widening of the gap between the total borrowing of the system from the Reserve Bank of India, which is around 2,40,000 crores, and the government balance, which is around 160,000 crores. This differential to me is simply the loss of permanent liquidity over the last 12 months or so.
Okay. Will it not be a problem in terms of the RBI endangering the system with too much of liquidity? If it were to actually bring the system to a square position, that is, banks are borrowing maximum, say, 5,000 crore net, or lending the system 5,000 crore, then, you will have to actually provide liquidity to the extent of 1 lakh crore. The Urjit Patel report makes it very clear, indicates very clearly that when the system was printing notes or doing OMOs with greater regularity as it did in the period from 2010 to 2012, we ended up having double-digit inflation. So while the impact may not be immediate, we may pay the price in the coming year. Is not that a fair argument, Hitendra?
Yeah, Latha, I'm sorry, I cannot agree with you on this point. I think we are talking about a system which is currently borrowing, which will borrow when the government balance is zero, about 80 to 90,000 crores, which will borrow 30-40,000 crores when RBI is at the peak of its WMA drawdown. The 50,000 limit which has been set 2 days back or so. So we are far from a system which is going to be flooded with liquidity. Flooded with liquidity is if there is so much money in the interbank system and there are not enough assets and we are giving it back at the reverse repo rate. If the money goes back to the central bank counters every day through a variable rate reverse repo operation, I am not able to understand at least how that suddenly, that in a banking system of 90 odd lakh crore, if you have a 40 odd thousand crore, which is less than whatever, 0.5% or something, which is given back to RBI, how that tail will wag the inflation dog so much. I'm not entirely aligned to that school of thought. I
think let us take a break, because we will come back and I will get your arguments on this issue as well, and look at other solutions that the Cash Management Committee, which the government has proposed to look at government finances. We'll discuss those points in a minute after this break.